Welcome everyone to the Daniel Krug & Associates Wealth Management Review for June 16th, 2022. Today's presentation is titled Run and Hide or Pivot. My name is Rocky Istrian. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug & Associates. Daniel Krug will be joining me in this presentation. Just a reminder, this presentation is for informational and illustrative purposes only. It is not a solicitation and should not be considered investment or tax advice. Couple housekeeping items before we get started. We're looking at about a 30-minute presentation. This session will be recorded. Everyone will be muted on this meeting. However, you can use the chat room to type in questions and we will follow up with you after. We want to thank CNR for their contributions, City National Rockdale for their research on the information that we're presenting today. Today's agenda, we're going to go over the current events that are kind of headlining what's going on in the world. We're going to update where we're at in the markets for June. And then we're going to talk about what opportunities are present for taking advantage of this time in the markets.
I think we got a lot to talk about today. Now, I don't think it's going to be a real long one because I believe we've got this pretty concise.
Yeah, we're going over some major things, but we're going to do it in a very concise, easy to understand manner. So we want you to kind of pay attention, especially to the opportunities. I think you know what's going on in the world,
Yep.
But we're going to recap that for you. And so why don't we get started?
Perfect. All right, so now we've got current events. When you think about what's going on in the world today, I mean, everybody watches the news. You've got continued geopolitical tensions with Russia's aggression towards Ukraine. That hasn't slowed down yet. You've got global supply chain disruptions and sporadic COVID lockdowns still taking place in China. They're having a bit of a rough time in China at this point with the way they're locking everybody down. You've also got inflation. It continues to move higher when was originally expected to be actually waning by now, but it hasn't.
Or at least slowing a little bit.
Yeah, it is. What's causing it? Well, ongoing price increases for energy and many consumer goods. And think about it this way. When you're talking about energy and you're talking about gas prices, which everybody is feeling, because now in Michigan we're well over $5 a gallon for gasoline, and for when you get into diesel, we've topped the $6 mark at this point. So when you think about it, our country runs on energy. It runs on trucks, and the trucks, if they're going to have additional expenses, that's going to get passed on to consumers. So that's why some of the consumers' goods are rising so fast. You've also got, with all this inflation, increased volatility in the financial markets. We said it in the beginning of the year that we certainly believe that we'll be positive before the end of the year, although when you look at things right now, you may not think that could happen, but it happens more often than many think. But we did say that there was going to be increased volatility. So the mature investor knows how to ride these things out, but we'll talk about strategies today that will help you actually end up on the other side in better position. Now, you've got the U.S. labor market. Home sales and consumer spending still remains strong. So that's a big deal right there, since the consumers are about 70% of the GDP, and it's not waning at this point. Then you got central banks considering more aggressive rate hikes to slow inflation. Any rate hike is going to make a move in the market for sure. When you think about it and go back in time to March 2020, this was back when we were basically in lockdown. Our country was in total lockdown at that point. It was kind of a self-induced recession. And at towards about, I believe it was March 23rd, we hit the low point in the market correction. But this is what the speedometers look like. When you're thinking about things from an economic and financial standpoint, this was looking rather dire. But you fast forward to February of 2020, and the leading economic indicators were looking, goodness gracious, almost all green. Everything was very positive at that point. Matter of fact, it was like that for months on end, which was really unprecedented. Then let's move forward to where we are today. Now, many people, if you read the news, you would say, oh my goodness, we're back to March 2020 catastrophes, but that's really not the case. When you think about it, we've got 9 green, 10 yellow, and 1 red, and that's still a very positive economic and financial forecast. And again, when you're looking at these indicators, we're looking at 6 to 9 months out on the indicators. So we think that we're going to have a pretty positive end of year. Again, even though we did hit the correction mark. And if you think about it also, when you're watching the geopolitical events, there's a little bit more of a heightened degree at this point. And certainly all eyes are on the Fed to see if they can slow the economy down. Now, the reality is, from a supply chain standpoint, there is a question mark out there. If we could just correct the supply chain, we could certainly get a better control on inflation. But at this stage, we're not really hearing anybody talk about solutions, are we, Rocky?
No.
Everybody talks about how bad the supply chains are, but they're not speaking about how do we get it corrected? Because there actually are solutions, but no one's speaking out about them, and I'm not sure why. But, it is what it is. We're just going to keep an eye on everything, just like we have on a day-to-day basis, to make sure everything is running well with the overall portfolios and your wealth management plans. Any thoughts on that, Rock?
Yeah, it's been kind of a not improving picture, let's say that. But, there are still some bright spots in it. And again, it's really going to determine how things look more towards the end of the year, how fast the Fed continues to move, to try to bring inflation under control through rate increases, pricings, got to stabilize. The supply chain's got to fill up a little bit. As long as the demand is higher than the supply, that's going to cause an issue with trying to get a control on inflation.
Yeah,
so
that's true.
Anyways, I think it's time to kind of look at the market and then get into the opportunities that we see moving forward.
Absolutely.
So I will take over from here and let's talk a little bit where we're at in the market. So this was the beginning of the week, and basically what you see here is the blue line represents the S&P index. So these are indexes year to date, and as you can see, this beginning of this week, we actually entered into what's called a bear market. Anytime the market goes down 20% or more, you move from what they call a market correction to a bear market. Now, is that going to stay there? We don't know. We've seen a little bit of a bounce back in the middle of the week. But right now, the S&P, as you can see, is down 21.33%. The red line represents the NASDAQ index, and what that has shown us, how much farther the tech-heavy NASDAQ index has gone down relative to the general markets. That's down 31% year to date. And when we look at the green line, what that represents is the bond market. Now this is where things have changed a little bit from history. Historically, the bonds, if the stock market was declining, the bonds would hold their value and continue to move kind of at least sideways, if nothing else. But you can see the bond market is actually down over 12% year to date. Double-digit losses in that, which requires us to really look at how we're going to rebalance portfolios moving forward. And the reason this is happening is because as interest rates rise, the current bonds that are out there at lower interest rates are going to be less valuable. So that's why you're seeing this decline in bond pricing as interest rates rise. And we'll talk a little bit more about that in the future.
It's interesting, Rocky, because people will ask, well, if the market's in correction, should we go into bonds? And Rocky really kind of pointed it out very succinctly as to where the bond market is. And we've been talking about it for years, that the bond market is in a secular bear market. So you'll have little mini bulls and bears through that secular market. But the problem right now is they're declining the same time the market is. It's very similar in design as it was in 2008. However, we are not in a 2008. This is not the same scenario.
Right.
So go ahead and go on, because you got some big names there.
Yeah. What I wanted to go into now is to kind of talk about some individual companies everybody knows and has heard of. Netflix, Facebook, Amazon, and Disney. When we look at what's going on with those stocks year to date, you can see, again, the S&P is the blue line at the top, down 21.33% at the beginning of the week. Look how far down Disney and Amazon has gone down, over 38% just this year. And Facebook is down, the yellow line, 47.8% at the beginning of this week. And look at how far Netflix has gone down. Netflix is down over 71%, almost 72% year to date. So when we think of the market, these are big names, big stock companies that have really, really brought the rest of the market down with it, because there's such a big influence on these indexes. So a lot of other companies aren't doing that bad. As you can see, something has to be actually higher for you to get an average. But we wanted to kind of point out some of the big losers this year so far. But the question is, what does Warren Buffett and these guys say? Buy low, sell high? Yeah. Should we be looking at these as opportunities? So we're going to talk about that in a little bit more here. What I wanted to also point out, if you now go back and just kind of look at what's happened to the S&P over the last 3 years, you can see the dotted line shows that we've actually given back quite a bit of the gains that we've had since January 24th of 2021. So we're back about where we were back then. So that's a little over a year, almost a year and a half ago. But what I wanted you to really see is, even though we're at 37.49 at the beginning of this week, look at where we were at the peak right before COVID. That's February 19th, 2020. It was at 33.86. We're still ahead of where we were during the peak growth years of the 2018, 19, 20, that we saw the huge growth in the market. We're still ahead of that. So anybody that's been in the market for longer than 3-4 years, they still should be ahead. But also look at where we were at the bottom of this COVID market on March 23rd, 2020. The S&P was at 2237. From that bottom to the top of January 4th, 2022, we went to 4888. Or 4818, excuse me, in 26 and a half months. That's 116% growth in 26 and a half months. That's not sustainable. The market got overbought, and now we're seeing that sell-off to correct.
Well, and that's a true statement. And the reality is, when you're looking at these numbers and the growth we've had, a lot of it was really inflated by all the extra money coming into the pipeline.
Yeah, the stimulus, a lot of it, they say, went into the market, which drove up the prices. So.
Yeah, it did. And if you run a trend line from 2018 on to where we are today, and the market is actually about where it's supposed to be if you were following that trend line. Now, again, nobody likes it. I mean, we'd much rather have it high. And we believe it's going to get back up there again. You know, I can't tell you when the next downturn is going to be, but I can tell you when the next 200-point uptick is going to be, and that's in the future. So that's why we want to stay invested in the market and make sure that we can actually take advantage of it. Because, you know, at the end of the day, you can't time the market. It's almost an impossibility.
Yeah.
Now, let's go on to some of the opportunities, because the opportunities when you have a downturn in the market are the key to increasing your overall net rate of return. And this is net of taxes, net of fees. And that's really what everybody wants, because they want to put as much in their pocket as possible when you do have growth. So let's talk about some of the opportunities. Now, you can't talk about opportunities without reviewing your liquidity, your income, and your investment strategy, because they all go hand in hand. This is more of a holistic look at the overall investment philosophy and process. And you can see here, we've got set up this diagram. Rocky put this together. I think it's a great chart, gives you a good visualization on what we're speaking to. And when you look at the 0 to 3 years, this is your cash, this is your conservative money, this is money that you can get to easily without creating problems in your investments when there's a down market. You go to the 3 to 7 year, that is more of a tactical value stocks, bonds, FIAs, fixed income annuities, and equity limit loss strategies. And this is going to give you income and growth at the same time. And it's it actually ends up refilling the conservative bucket. And then you go into the last bucket, which is your growth bucket. This is where you want most of your returns to be coming from. And this is also the area that most of our clients are going to have their Roth or tax-free money. Because obviously we want the tax-free money to grow the fastest. So taking in this concept, the issue right now is if people are taking income out of the market and the market is going down, are we not just accelerating that process, accelerating the loss? And the answer to that is yes. So you need to have a strategy to combat that. So let's talk about some of the strategies here. The first one really is complete a Roth conversion while the market is down. Step one, you convert the IRA to a Roth IRA from more conservative portfolios, bringing them to a more aggressive portfolio. So on the way back up, they're going to come back faster and obviously tax-free. Then you can look at the draw and let heal strategy. Everybody that was around during the COVID crisis and that correction we had at that point, most of our clients that were in the stock market taking money out of the market on a monthly basis, we employed the draw and let heal strategy. So what is the draw and let heal strategy for those that don't know? Well, the first step is you stop withdrawals from investments until the market rebounds. Because again, we want to stop the acceleration of that downturn. Number two, if you have life insurance, you're going to access the life insurance policy's cash value, or an alternative is to do a HELOC, a home equity line of credit, to replace your income. And keep in mind that the monies that come out of those two accounts are all tax-free. So you don't even need to draw as much money out as you were when you were pulling from a taxable account. So you do this all the while we're in the downturn in the market. Now, let's go to the next step, or the next strategy. This strategy is a reallocate risk up strategy. And this is where if your risk tolerance allows it, you shift from a lower risk profile portfolio to a higher risk profile portfolio. And again, while the market's down, if you make that switch, the higher risk portfolio will be more aggressive and it will ride up the upside of the market a lot faster than a conservative portfolio will. And then at the end of that, you can certainly go back and reallocate your risk once the market gets back to even. Now, when you're talking about opportunities, Rocky, you can't talk about opportunities without talking about something that, well, Warren Buffett quotes from time to time. And we've got 3 of those quotes, and these are very apropos at this time. The first one, a market downturn doesn't bother us. And Rocky, it really doesn't bother us either. And again, nobody likes a downturn. We just don't. But if you're going to have it, you better have a strategy to make sure you're going to be better off on the other side. So what does Warren Buffett quote? He says, "It is an opportunity to increase our ownership of great companies with great management at a good price." And that is true. Things are now on sale. And being on sale, why wouldn't we buy more? The next quote, this is a great one. "The stock market is the best device to transfer money from the impatient to the patient." And I am really, really proud of our clients, because I can again count on one hand the number of clients that have called in and said anything about the market. The overall or overwhelming talk right now is, what is the strategy? What are we going to employ right now to get us better off, just like we did when the COVID crisis hit? We want to be patient. We want to be mature investors so we can actually take advantage. This is where that wealth transfer comes from. This is where you're going to increase the amount that you will have long term and the amount you get to keep. And then the last quote is, "It is wise for investors to be fearful when others are greedy, and greedy when others are fearful." And that again just goes to that whole story of, buy low, sell high. Yep. And the market is low right now, Rocky, so yep. that's where we should be right now.
And there's fear in the market. Yeah. So that should tell you. What would Warren Buffett do?
He'd buy.
Exactly what he is doing. If you research him right now and see what's been going on with Berkshire, they've actually been buying as the market's been dropping.
Absolutely. And that kind of brings us to strategy number 4, buy low. If we have any additional money on the sidelines in CDs, which really aren't making any money, we're actually losing money in CDs because inflation is actually taking that buying power away. But if you have money on the sidelines, this is another great opportunity to add money into the market and get that great return. Once the market comes back to even, you can always slide it back into a bank account if you want, but you'll have realized a much greater return. I've told a lot of clients I've dumped extra money into the market while the market's down because I want to do the same strategies we're doing for our clients. So that's what we do right now. Now, what happens in the post-correction playbook? Well, one of them is the HELOC and the life insurance, the draw and let heal strategy. We kind of want to reverse that. So we'll stop the withdrawals from the life insurance or the HELOCs. Once the market rebounds, we'll restart the income from the investments based on pre-crisis distributions, and we'll replace the funds in the life insurance policy, or we'll pay off the home equity line of credit from the rebounded investments. And then finally, we want to return our overall risk level in your portfolios back to pre-crisis levels. Yeah. And that's all designed because, we end up with another crisis a year or 2 years from now. We don't want to be in a Ferrari at the top of the hill going down as fast as we can. We want to keep our risk tolerance at the proper level. Right. So that's the playbook. And that being said, I'm going to pass the clicker over to Rocky, and he's going to kind of go over the recap.
Yeah. So we covered a lot of stuff in a short amount of time. Let's just kind of touch everything that we've talked about. The Russia-Ukraine conflict isn't getting resolved. That's not going away quickly. COVID, mainly in China, but other supply chain disruptions continue to hamper efforts for an economic recovery. And
Hey.
yes,
Could China be paying the price for spreading a virus?
I
It's
don't know.
coming back to roost.
I think we're all paying the price for it right now.
Well, that might be true.
And the last point here, the Dow and the S&P did dip into bear territory. We've seen a little bit of a bounce back, but it's going to continue to go up and down at this point for a while. And it's going to also depend on future rate increases that we see coming from the Fed. And obviously there's talks of recession. So that the headlines are also driving the fear in the market, which is driving the buying opportunities that we're seeing right now. So our recommendation, don't panic. Like we talked about, you review your liquidity, your income needs, and your investment strategy. If you know you've got the liquidity and the income you need to ride out a slowdown and a downturn in the market, that's where we can take the investment strategies and really kind of boost the long-term rate of return on those portfolios. And then you want to implement our advanced planning strategies, as I was just talking about, take advantage of those, and do what successful investors do during market downturns. So remember, if you, like I said earlier, if you research really what's been going on with Warren Buffett and big investors, I mean, look at what Elon Musk did.
Oh, yeah.
He offered $43 billion for Twitter as the price is dropping. Because these guys know, they're not thinking 6 months from now, a year from now.
Right.
They're looking at what to buy low and where it's going to be in 3 to 5 years from now. So they are long-term investors, and we need to do the same thing.
Well, absolutely, and I think it's really interesting because with our clients, they're long-term investors too. I believe they think the same way. What are the opportunities? Let's take advantage of it, but let's stay invested so we can actually get that long-term return.
Yep.
When you think about the markets and where we're going, I think you had touched on the fact that the interest rate hikes are going to be part of where the volatility is, and I absolutely agree with that. But there's another factor out there, which is one reason that I believe that we're going to be up by the end of the year, and that factor is the midterm elections. It looks like at this point, there's still several months away, but it looks like at this point there's going to be a red wave if the Republicans take over the House, or if they take over the Senate. Then there'll be a bit of a stalemate, and I don't know, at this point, maybe a stalemate's better than what's happening right now. And maybe, I think if we do get that red wave, I believe we're going to have an uptick in the market after that.
Yeah, we do need the political realm to settle down a little bit too. So.
Oh, absolutely. If it does that, I think we'll get where we need to go. So we do have solutions. Again, we are a full wealth management firm. When you're looking at what we do, we look at things from a very holistic standpoint. It's not just investment consulting, which that in itself entails 3 major areas: investment solutions, cash and banking solutions, and trust services. But it's also the advanced planning, the wealth enhancement strategies, the wealth transfer strategies, wealth protection strategies, and let us not forget the charitable giving strategies. We have it all for our clients, and we do employ them where possible to really fix a higher net rate of return for our clients. Everybody says, tell me more. Well, go to our YouTube channel. You can go to Daniel Krug and Associates YouTube, and you can click on any of the past videos there. It might even be easier for you to just go to mydkna.com, our website, click on Watch Us, and then click on DKNA YouTube, and it will take you directly to our YouTube site. And that's where you'll be able to see the full version of the videos, and you'll be able to see some snackable videos on there. The 3 to 5 minute videos when you have just a little bit of time to kind of catch up on things. So that's what we have for today. I say it all the time. You say it all the time, Rocky. There's no need to worry. You take care of your family, and
we will be taking care of you guys. So we're ready for the future. Thanks for joining us on the webinar today, and have a good day.
Bye-bye.